Hello investors and future investors, welcome to the channel. For today's video, I'm going to be giving you a step-by-step walkthrough of how to trade Arista if I were to trade Arista. Now, Arista is one of those cloud-based stocks, so I'm going to give you a complete walkthrough of what I would do if I were to trade Arista right now. For those of you new to the channel, welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim. And on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to give you a step-by-step walkthrough of a decision making of which option strategies I would employ if I were to trade Arista Network. So you guys know how we do it. We're going to go ahead and get down and dirty with options. Now, Arista's is going to be ticker ANET. Now let's go ahead and get into the video. So down here, I'm just going to give you guys a bit of information in order for us to do some basic due diligence. So down here, you could see that the 52-week low for this stock is going to be 59.43. Now, I want you guys to remember this. These things are going to help us make a very informed decision. The 52-week high is 133.58. Now, we're going to continue scrolling down just to get some additional information about this stock. Now, as you can see here under the trading trends, when you go to the Robinhood one, a lot of people on Robinhood, retail investors like you and myself, we actually buying Arista. If you go over to hedge funds actually are selling more than they buying, but they're still buying. Now, if we go over to the insiders are buying quite similar to what they're selling. So they're neutral on this stock. We're going to go ahead and go down and get some more information. And if we go all the way down to the analyst ratings, which is going to be right here, analyst ratings, you're going to see there's a 79% of the analysts said this is a buy. So they really think this stock is a buy. Of those 28 analysts that rated this stock, 0 is saying sell. And some are saying if you do have it, then you should probably hold, which is around 21%, as you can see to the right here. So far, this stock is a buy. Now, bear with me. We're going to be making a very informed decision based on all this information that we're gathering. So let's go down one more to the research report. The research report is going to be right here. Now, if you guys don't have this kind of information on your Robinhood, then you should strongly consider getting the gold membership, because all of this, as simple as it may be, it really helps you make a very informed decision before deciding what option contracts you want to implement. Now, I like the research report because of this number right here. This number right here gives it an estimate of the fair value. So what they're saying is that Arista's fair value right now is going to be $82. Also, I would need you to remember this number. We're going to touch on it again as the video goes along. Now, if we go down to earnings, you could see here that the estimated earnings per share is going to be 0.65. However, they're expected to release earnings on July 29th. So that gives us about another month before they release earnings. Now, let's go all the way up and we're going to get some technical analysis. And we do that by going to the advanced feature right here. We're going to go over to the 1-year outlook in order to see how the chart seems now. First, we're going to consider is this blue line right here. For those of you who do not know, this blue line right here is what's known as the 200-day moving average. What the 200-day moving average does is that it tells us where the price have been trading for the last 200 days or the last 6 months. So this stock has been trading around the $95, $96 for the last 6 months. However, the current price is at $86.32. So the stock is trading $10 below its 200-day moving average. As you can see, the price to the bottom here. Now we're going to go ahead and get a second confirmation for our technical analysis, and we're going to do that by using our RSI right to the bottom here. The RSI is a momentum indicator, so what we're going to be doing, we're going to be following this line right here. The RSI here says it's about 48, around 50 RSI. So it's pretty much neutral. If you guys do not know what the RSI is, or you guys do not understand what I'm doing with the chart, just go ahead and search the channel for a video called RSI. It's going to give you a step-by-step walkthrough of what the RSI is and how it's used before I make a decision. Now, with all this information we have, what option strategy am I going to go ahead and do with that? So let's get back into Arista. And then now we're going to go ahead and perform the option strategies. So let's go ahead to trade ANET options. And now I'm going to give you an option strategy if you have enough money to go buy the stock outright. I'm going to give you an option strategy if you guys only have a couple $100 in your portfolio. I'm also going to give you an option strategy if you're very bullish with a long-term outlook of this option strategy. So the first option strategy I would use with this stock is going to be, I'm going to go to sell, I'm going to go to put, I'm going to choose my strike date. My strike date is going to be roughly around 2 weeks out. So I will be going with the July 11th, which gives me about 20 days for this trade to expire. Now, what I would do based on the information I just saw, I would go ahead and choose my strike price below the current share price. The strike price I would be going with, you probably have guessed it by now, which is going to be the $80 strike price. The reason why I would choose the $80 strike price is that the $80 strike price gives a very good level of support. So with the $80 strike price and this option strategy, you're going to get paid. The amount you're going to get paid is going to be $1.15 in the option world. When you translate $1.15 into the real world, that's going to be $115. And that's simply because each option contract contains 100 shares. So you multiply 1.15 by 100 shares, and that's going to give you $100. This first option strategy is going to be known as the cash secured put. In order for you to implement this option strategy, you will need to leave a collateral. The collateral you're going to need to leave is going to be whatever your strike price is. So in this case, it's going to be $80. So you're going to multiply your $80 strike price by, once again, 100 shares. And the amount of collateral you're going to need to leave to do this option strategy is going to be $8,000. Now, if you do not have $8,000 in your portfolio, but you're still pretty much bullish on the stock because the cash secured put is a bullish option strategy, then here's what you could do. You could leave the parameters as is and just make a slight tweak that's going to make you be able to afford to do this bullish option strategy. So what we're going to do now, leaving almost everything as is, we're going to switch from sell. We're going to switch over now to buy. Now we're going to go ahead, we're going to choose the next strike price right below our $80, which is going to be the $79 strike price. Let's go ahead and click into that one. We're going to hit continue. We're going to hit review order. So if you are bullish on this option strategy and you do not have $8,000 in your portfolio, then maybe you'd like to consider this new option strategy, which is known as the put credit spread. The put credit spread is an additional option strategy that's going to give you money in your portfolio as soon as you do it. The good thing about doing the put credit spread, if you do have a small account, then you only need $100 in order for you to do this trade. Now, you got to be careful with this trade. And the reason for that is that this trade is what's known as a defined option strategy, meaning there's a certain amount that you could lose. Fortunately, for this particular trade right here, the amount you stand to lose is going to be $80. So how did I come up with the $80? It's going to be the amount of money you receive once you do this option strategy, which is going to be $20. You're going to subtract that from the amount of collateral that you need to leave, which is going to be $100. So your max loss on this trade is going to be $80. So by doing this option strategy now, if the trade were to go in your favor, you're going to be able to secure $20 and you're going to get your $100 collateral released back to you, and you just keep rinsing and repeating. Now, those are two option strategies that I would do on Arista if I were to trade it. I'm primarily a long-term investor more than I am a trader. So my strategy that I would use personally on Arista, let me go ahead. I'm going to show you right now. So let's just clear this off a bit. And then now I'm going to go to buy. I'm going to go to call. I'm going to go ahead. I'm going to select a strike date. The strike date I will be going with is going to be June 18th, 2026. That's going to give me 362 days for expiration. Like I said, I'm an investor more than I am a trader. So I have a more longer term outlook on the stock market. Now that I have buy and I have call and I have a year for this option contract to expire, now I'm going to go ahead and choose my desired strike price, and I'm going to go ahead and choose it below the share price. The price I would be going with once again is going to be the $75 strike price. Now, the $80 strike price that we featured in the first two option strategies, that's a perfectly okay strike price. The reason why I'm going to go with the $75 strike price, personally, once again, I'm a very conservative investor, so I like to give myself a little extra wiggle room. Hence the $75 strike price. This new option strategy is going to be a buy option strategy. So I'm going to have to pay. The amount I'm going to have to pay is going to be $23.70, or $2,370. This option strategy is known as a long call, a leaps option. Now, you could do a leaps option right now at the current share price at $86, or you could probably wait until the price goes back down to probably the fair value, which I just showed you, of $82. It does not really matter. The reason why it does not really matter is because your outlook is an entire year. You have an entire year for this trade to work in your favor. Now, once you get this leaps option in your portfolio, you could simply just leave it there and do nothing. And all you're waiting for is Arista to increase back in value. Now, remember, Arista had a high of $133. It also had a low of $59. The current price of Arista is $86. So this share price is a lot closer to the bottom than it is to the top, meaning you have way more upside than you do downside. So you simply hold this contract in your portfolio and you wait for the share price to go up. As the share price goes up, then you're going to go ahead and just make money. Feel free to close off this option strategy whenever you reach your level of profitability. That's going to be based on your own personal preference. Now, a key thing to note is going to be this right here, which is going to be your break even. Your break even is going to be $98.40, meaning that the share price needs to be at $98.40 by expiration. For you to make money, it does not need to be at $98.40 anytime. It just needs to be by there within a year. Now, you could have this long call or leaps in your portfolio and do nothing, and the share price will appreciate. I almost guarantee you it's going to appreciate. However, while you're holding it, there's another thing you can do in order to make consistent income, and that's pretty much my bread and butter. So, having that leaps in your portfolio, this is what I would go ahead and do. I'm going to switch now to sell. I'm going to go ahead to call, and now I'm going to adjust my strike date. I'm going to go to the same date, which is July 11th, which gives me 20 days to expiration. And now I'm going to go ahead and select my strike price. Remember, I am using my leaps option that I just purchased on Arista that expires an entire year in order for it to make some additional income. Now, the strike price I will be going with is going to be the $95 strike price. I just showed you that the break even is $98. However, you do not need the break even to be $98 by July 11th. You need it to be $98 by June 18th, 362 days from now. So I'm going to be going with the $95 price, and that's going to be paying me. The amount of money is going to be paying me is going to be 0.70 or $70. The reason why I would do this personally is that while I'm waiting for this share price to continue going up in order for me to make some money, I'm going to go ahead and do this next option strategy in order to make consistent income to grow my portfolio. Now, if you're going to choose the $95 strike price as opposed to the $98 strike price, just know you're going to have to manage the trade a bit more. The other reason I would not choose a $98 strike price is also going to be the amount I'm going to get paid. The amount I'm going to get paid for the $98 strike price is going to be $35. I just don't think it's worth it, me getting $35 in order to wait that long. Hence, I prefer to choose a $95 strike price and then adjust it if needed. Remember, options is not black and white, and there's only one way to learn options, and that's by practice, practice, practice. So there you have it, investors and future investors. If I were to trade Arista right now, those are the option strategies I would be using. If I have a big enough portfolio that would allow it, I'd go ahead and start off with a cash secured put, which is going to allow me, if the trade goes against me, it's going to allow me to get Arista at a much better price. With the $80 strike price, I will be getting 100 shares of Arista below the fair value of the stock if the trade goes against me. If the trade does not go against me, then I make some money until I get my desired price. If you are trading with a portfolio that only have a couple $100 in it, then you could consider doing a put credit spread, and that's going to allow you to make some money as well. Just remember to also be careful with the put credit spread because that's a defined risk option strategy, and it's also a bullish option strategy. Now, personally, for me that have a way long-term outlook on the stock market, I would choose an option strategy that gives me way more time to work in my favor, and that's going to be the leaps option strategy. I'll simply go out around 365 days or more and pick up a long call or a leaps option. Once I have that in my portfolio, then I'm going to go ahead on a weekly or bi-weekly basis and do covered calls against it in order to make some extra income. I do not need to, but I'm just going to do it just to make some extra income. So that's it, investors and future investors. That's how I would trade Arista, ticker ANET, if I were to trade it. Now, for those of you guys that made it to the end of the video, you guys are the real investors and future investors. Go ahead, like the video, subscribe to the channel. Make sure to hit the notification bell to get an alert when I post a video. But most importantly, if there's anyone out there you know struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. We're trying to help as many as we can get away from that 9 to 5, or at least supplement their income with options trading. Now, until the next video, keep pushing your investments.